This is a production of the Parsons Trading Institute. All rights are reserved. Disclaimer required by the CFTC. If you risk it, you can lose it. ReversalMagic.com presents the Reversal Magic video course. The power to predict, the power to profit. Reversal Magic training video number 1. How to determine future reversals. If you knew when a market would change direction, when it would form a high or low, would you be able to trade it for a profit? Would you be able to buy and sell successfully? Well, odds are you could. But is such the ability to determine when the market would change direction a reality, or is it just a trader's dream? We all would love to have that advanced knowledge, but can we actually do that? Well, the answer is yes, scientifically it can be done if you use the power of reversal magic, a tool based on the wave action of the market. An example here are these two reversals that you see, the two vertical lines, that will set up the buys and sells of a market. Now currently we are looking at a low area, so we're looking at a potential buy here, and so a buy would be established right on the time of the reversal. Following this, we would set the high or low, in this case a low since we have a buy, as a stop. Anything that exceeds that would have us out of the market. In turn, we would look at a sell, or at least an exit, at the following reversal bar. In this case, because it's a high, we're looking at a sell. And so we would sell, again using the bar's high as a stop. If the next bar exceeds that, then we would exit. As you can see, the market has responded very effectively off of these points. While it's not a holy grail, it is a powerful tool. It's just a matter of understanding how to use it successfully. And that is, of course, what this video is all about. Using this power, this awesome power of the reversal magic to actually trade. One of the first things I like to emphasize about reversal magic is that it is a tool. It's not a complete system, nor a cure-all for all that ails you in regard to your trading. You see, there's a lot that goes into successful trading, such as trade management, money management, and control of emotions. But without question, reversal magic is an incredibly powerful tool, capable of enhancing anyone's trading. But before we get to that point of being able to use reversal magic, on the very foundation it needs to be understood as a tool, because that impacts how you look at it and how you use it. To understand that, let me illustrate it this way. I have used a saw and a hammer many times in the past, a separate, different tool. I have built many things out of wood, and you probably know how to use a saw and hammer as well. And if you do, then you can appreciate this. If tomorrow I got up and decided to build a cabinet, well, I guarantee you that the end result will not be the same as a professional cabinet maker. It's not that I don't know how to use a tool, and I may be using the exact same tools as a professional. What makes the difference is the skill, the understanding of the individual, and the experience. The end result, or the quality of the end result, is dramatically different. The same thing is true in regard to reversal magic. Now, it is a tool that anyone can use. It's very simple to understand. At the same time, there are factors in regard to the skill and understanding of an individual that will impact the accuracy and the strength of the reversal chosen. Obviously, then, we want to bring your skill and understanding up to a level that will ensure that the ones you choose and how you use this tool will be of high quality. In order to do that, we're going to address a number of things in this series of videos. And by the end of the video, you want to be able to answer these questions for yourself. For example, the first question is, how do you determine a reversal? And not just determine it, but how do you correctly determine a reversal? The second question you want to be able to answer is, what adjustments are necessary in regard to timing? When and how do you make them? The third question is, how does reversal magic actually work? How can you better understand it? The fourth question is, which reversals do you use? Which do you avoid? What stands out as most significant? And how do you determine it? And finally, how do you actually trade reversal magic in order to make a profit? all these questions we're going to be addressing in this series of videos. So from this point, let's start by taking a look at reversal magic and the basic concept and how to actually determine a reversal. Reversal magic is based on a wave science principle, which gives us a lot of confidence in the reliability of the method because it's based, well, scientifically and mathematically. To understand the concepts related to it, we're going to look at what it's based on. But before we do that, I want to explain a little bit about how you determine reversal magic. Because it's scientifically based, there are two approaches to that, graphically and mathematically. And we're going to focus on the graphical method first because that's, well, first off, that's the easiest to comprehend. And it goes well with the visual demonstration we're going to have to establish the principle. Before you right now are two wave patterns. If you're familiar with sine waves, that's great. If not, don't fret. This is going to be simple. We're only dealing with two waves. But let me explain a little bit about sine waves and how they work. Sine waves are nothing more than up and down motion that you're dealing with, creating a wave pattern. They are often referred to or referenced in relation to their amplitude, which is the height and depth of the pattern, and the frequency, how often they repeat up and down within a given period of time. If you look at these two wave patterns, what you see is the yellow one is much more frequent than the white, but doesn't have the same amplitude. The white, in contrast, has greater amplitude, but doesn't occur as frequent. Now, both these waves are very distinct from one another. But what happens when you combine these two waves? Well, what you end up with is something very elaborate. In fact, you may have recognized something similar on a market chart before. Now, realistically speaking, anything that has waves in it generally has more than just two waves, so a market chart is going to be much more complex than this. But the two waves that we have combined here gives us a basis for establishing the concept. So how does reversal magic work? Well, reversal magic is a triangulation of the wave interaction. Reversal magic, in the graphical approach, you simply take a high with another high to create a diagonal line. So obviously one has to be higher than the other. And you take a horizontal low, or a low between them, to create a horizontal line. And where they intersect gives you the time of the reversal, as you can see right here. You can do the same thing in the opposite direction. You can take a low and combine with another low, creating a diagonal line. Obviously one is higher than the other. You can take a high in between them and create a horizontal line, creating, where they interact, a reversal point in time that is the reversal of the market. And you can repeat this over and over again, one after another, creating the points that you would use for the reversal. Now, there's a couple things that is important to emphasize here. Although in this case it works out that an upper triangle gives you a high and a lower triangle gives you a low, this is not always the case. Reversal magic gives you the time when a reversal is to be expected. It's not necessarily low, not necessarily high. It does not tell you that. It only tells you when the market will reverse or change direction. The second thing is that this is based on the market interactions, not on the actual wave patterns. The actual wave patterns will not necessarily always be equal to the exact lows and highs that form because there's a blending of the two or multiple waves involved. As a result, you're creating a triangulation of the interaction, not of the waves themselves. It's an important concept to understand, as we will get to later. At any point, this is as simple as it comes. It's very easy to do. Now there is one other technique that we refer to as opposing point last, and we're going to cover that in a moment, but the first thing we're going to do is go from here to an actual trading chart. This is corn, a popular grain in the commodity markets, and of course it could be any market that we're looking at. I happen to like this one because it gives a number of good examples to work with. We have a nice uptrend and downtrend to work with, plus a number of points to derive reversals off of. Which brings us to the very first issue that we want to address when dealing with an actual market. The first errors that individuals will do in determining reversals is that they'll take every little bump that the market throws at them to create a reversal. And the first thing and first rule that you want to focus on is that you don't want to take every little bump there is. If it's in a swing or trend, typically it's not going to give you anything of any consequence. You want the points to stand out, and if you look at the market, you can see that it will form zigzag patterns as it moves in its uptrend or downtrend, and those are the points you want to focus on, the distinct highs and lows that set themselves apart from one another in a zigzag pattern. Not every little bump that you can find within the market. So let's look at some examples. We can start with a couple of lows and triangulate with a high. Let's start with these two lows, for example, and we'll triangulate with this high, and what we end up with is a reversal right here. And of course, if you look at this, if you were looking at the market and you saw it come back down and knew that the market was reversing here, what could you have done with it? Well, very nice trade there that you would have made a profit. Of course, as the market moves up, you now have another low that you can use to triangulate, and so we can even take this low and triangulate with this high, and as we set it in place, we can go over and we have the reversal right here. And so, knowing the reversal, the market's going to reverse right there, what could you have done as it reached that point? Well, you had a good opportunity to profit all the way down here. Of course, we're not just dealing with two lows and a high, we also have the ability to use two highs and a low. So let's use an example of that. Here's a high, and we can use it with this high, and let's take this low, for example. And when we triangulate it, we end up with right here, which gives us this reversal, and very nice one here. Obviously, a great profit opportunity if you knew the market was going to reverse direction. In addition to that, there are other ways that you can triangulate to determine reversal. For example, taking advantage of gaps. Now, gaps are significant events within the market. And we're not going to go into too much detail at this point. That will come later about gaps and their significance. But when it comes to creating reversal, we can use the points of the gap, either what begins the gap or ends the gap, as a point for triangulating, or a point for the diagonal line. Example would be taking this high and using it with the very beginning of the gap, or in turn taking the high and using it with the very ending of the gap. And of course, that right off the bat, you can see there are 2 points we can derive from the gap. In turn, you would take a horizontal line off of some level, for example in this case a low, and create a reversal. Now in this one we end up here and we end up here. We get this lined up, and so what do we end up with? Well, we end up with this reversal area. This one is a bar early, but it still is part of a significant reversal. In this case, we have a reversal, but what it does is it stops or halts the market from receding down any lower, and so for 3 days it sits in its little consolidation before it's finally able to overcome that support and continue lower. So it did have a significance, not a major one, and this is typical of a gap. Typically one side will be stronger than the other, but both will give you some kind of reversal or some kind of signal that you can work off of, and that's an example of using a gap. Now in addition to that, we also have the opportunity to use what's referred to as opposing point last. Now opposing point last requires some qualifying, because typically when you set a horizontal line off of any situation, you're going to use the horizontal line in between the two diagonal lines, not one afterwards. You wouldn't use these two lows and triangulate it with this high, because it's out of the range of being in between the two lows. Having said that, there's an exception to that, and that's when the high or low is the last point within a major swing or trend. An example is this high right here. We have a trend that runs from this low on up, and the market continues to set new highs along the way until it gets to this point. From here it breaks and it starts to set a lower high, isolating this one point or this one high all by itself. And having done that, you now have the ability to create a horizontal line off of that. This is the only time that you would use a point after the two lows or two highs. And when you triangulate that, well, what do you end up with? Typically it's a decent strength reversal, and we see one right here which sent the market up to this other reversal that we had already determined in an earlier triangulation. And so we had a couple of nice swings there that we could have taken advantage of, and so it was well worth knowing or being able to determine that using this opposing point last version. In addition to this, brings us to another factor that you will run into. One of the questions that frequently come up are, am I just limited to the highest high, or can I use a secondary or minor high or low when I'm using it as a horizontal line? Now this corn market doesn't have a lot of examples, so let me go to another market where that typically does have multiple points. And here's wheat. Wheat has a real issue of doing this repeatedly, but let's use this as an example. Here I'll take a couple lows, and note that we have a significant high right here. It stands out and it's pretty strong. In addition to that, we also have this other high right here that is distinct, but it's still much lower than the other high. So if we triangulate that, the question is, can we do that, or is that out of bounds? Well, the fact is that as long as it's distinct, you can still use it. In this case, we end up with reversals that we have one right here, and the market moves downward, and then of course we have a reversal right here which moves or sends the market upward. Obviously the higher ended up being the stronger, and typically that will be the way that it works, but still this one was significant of its own accord and could have been a good signal to determine a reversal. And you can repeat that over and over, and it's not just on the horizontal level. We can also even go to on a diagonal basis. Here are multiple points, and we can use the same high in between them and determine a reversal, and that can be applied in both cases. Here we have a high that occurs right here, and then we have a low that occurs right here. So in both cases we have a significant signal that we can use to work with. So multiple points are perfectly alright, but they need to stand out as distinct. And so make sure that they have a wave pattern where the market is zigzagging up and down that you can use. And as long as it's doing that, then you have a basis for determining a reversal. Now that's some examples of how you determine a reversal in an actual chart. We're going to look at another market. This is the Russell E-mini on the daily time frame, and I've taken the liberty of drawing in a triangle already. Here we have the first high, the second high, the low, and of course determine reversal point, which would be this bar, resulting in a dramatic decline in the market and a great profit opportunity. But this time I've taken the liberty of drawing a triangle because we're going to only use it as a reference, because now we're going to focus on the mathematical approach. Now don't let that scare you. This is going to be pretty simple. But of course the question arises, why do I have to use mathematics at all? Well, the fact of the matter is that in the majority of cases the graphical approach is perfectly fine. In fact, it is the most effective and efficient way of determining a reversal. But there are specific reasons why you would want to use the mathematical. Let me just show you an example. Let's say that we take another triangle using the same high, first high, but this time another high, secondary high further along, and a low that's even lower, resulting in a larger triangle. The more that you extend out a triangle, the larger it is, the lower the profile. And by that I mean the angle of the diagonal line. The more it draws closer to a horizontal direction, then it is more critical that you absolutely have the correct placement of all points of the lines. Failure to do that would result in a dramatic difference in the end result. Let me show you just as an example. Just watch for a moment this area and what happens when I just simply move the line just slightly. Do you see how much it makes a difference? The fact is, it changes the time of the reversal, not just days, but sometimes a week or more, which of course would dramatically impact your end result or your ability to trade it. So therefore, the larger the triangle and the lower the profile, the more important it is to either A, get these points absolutely correct, or to use the mathematical approach. And since the mathematical approach is relatively simple, we're going to now focus on that and see how to actually accomplish that. We're going to start off by looking at the formula for reversal magic, which is actually right here. It's D times F divided by E gives you your RM point. The RM point simply being the time of the reversal. Now while this looks a little complex, it's just elements or values within the triangle itself. If we look at this example, this is a triangle much like the example we see in our chart. We have our first point, which is a high or first high, our last point over here, which is the second high, and our opposing point, which is a low right here. Now of course, if you have a reverse triangle, then the points still apply in the calculation. But in this example, it basically boils down to this. You would normally draw the diagonal line across like this, off the first point and the last point, and the horizontal line off of the opposing point. So these are the points we would be using if we get this in perspective, and the value of the formula is just nothing more than values contained within this triangle. So what are the points of the formula? Well, the first item is actually a time factor. The time, the amount of bars between the first point and the last point. That would give us D. The second part of the calculation is a price difference between the opposing point and the last point, and that would give us F. Once we determine those values, we would multiply them. Then we would divide them by E, which is the price difference between the first point and the last point. That gives us E and our dividing factor, which would give us then our RM point, which is nothing more than the time or the amount of bars from the last point until the reversal. Now this may sound a little confusing, so let's actually look at it on the chart and see how it would work. In the chart, this would be our first point, and so the high here would be our first part of the calculation. This would be our last point, and this would be our opposing point. And so the first part of the formula is actually the time between the first point and the last point. Now we can count the bars, or if you have a tool such as a cycle tool, you might be able to do this very quickly by spreading across and clicking, and you'll be able to see what the actual count is. In this case, 20 bars. So 20 bars is our first calculation that we would be using in order to determine the reversal in the future. The second factor is the price difference between the second high right here, which is the last point, and the opposing point, which is right here. So in this case, we're looking at approximately 743 minus 696.2. Once you determine that value, you would multiply that against the actual number that we had before, which was 20 bars. Having done that, you now need the dividing factor. Dividing factor is nothing more than the very first point subtracting the last point, or in this case about 788 minus 743, and that would be divided into the total that you've already calculated. Now what that provides you is the amount of bars or time until the reversal from this point to the actual reversal. Now, this by itself doing manually takes a little effort, even though it's relatively simple. But we have provided a very easy tool to be able to do this for you automatically. You just simply input the numbers, and that's the Microsoft spreadsheet. And so we're going to take a look at the spreadsheet and see how we can use that to determine the actual reversal. Here's the spreadsheet, and before we look at the actual calculation in relation to our triangle, let's talk about the spreadsheet for a moment. The spreadsheet actually has two pages. It has a date calculation in which you would apply a specific date, and then there's an intraday calculation which uses actual bar count. And we'll talk about that a little later. Right now we're just going to focus on the one with the date. It's because that's related to the subject at hand. And I've taken the liberty of putting the information in, but before I talk about that, again, one other factor is in fact that there are two sequences of calculations here. And very simple to understand, we have two highs and a low, or two lows and a high. A different sequence, so therefore the calculation had to be changed in order to accommodate either one. So if you're dealing with two highs and a low, use the higher one. If you're using two lows and a high, then use the lower one. Very simple. Having done that, we now look at the actual reversal we're considering. I've taken the liberty of taking the first high, the first point. We put in the price, 788.2, the date, 5/5/2006. The last point, which is our second high, the price level, 743.4, and the date, 6/2/2006, so June 2nd, 2006, and then the low, which is our opposing point, at 696.2, and the date of May 24th, 2006. Now what that does is return a certain number, and typically, in this case, it's 29.5. Typically we'll have a fraction with it. You note that it's not an even series of days. It's not 29 days even. It's not 30 days even. It's 29.5. We take that and use that to give us our date, which is calculated, in this case, July 1st, 2006. And we'll talk about that in just a moment. But first off, let me talk about this fraction. The fraction is useful if it is one way or the other. Now remember that when you're dealing with a date, the spreadsheet doesn't know when this high actually came in, whether it was in the morning, the afternoon, or the mid part of the day. Same thing with this low. It doesn't know when it came in, whether it was in the morning, afternoon, or the mid part of the day. So therefore it's very limited in giving you any type of window as to when the reversal will occur within that specific day. However, if the fraction is much higher or lower, like for example here we have 68.82, or perhaps if this was 29.2, then the likelihood is that 29.2 would mean that you could likely expect to see the reversal sometime in the morning, and this reversal, 68.82, would be expected sometime in the afternoon. So it does give you a little bit of sense of when you would be able to see that reversal. However, if you want to refine the reversal, we strongly recommend that you take a lower time frame, like an hourly chart, and determine a reversal for that day. Typically, every reversal will have a corresponding reversal on a smaller time frame. So once you determine the day, look for the lower time frame that stands out as far as a reversal, and you can refine that all the way down to 1 minute or even the tick chart if you so desire. But for the initially, this does give you some sense. Now in this case we have 29.5, so that kind of lends itself either to the mid part or the morning, and that fact does not really give us a bias in any way whatsoever, so we can't use that in this particular case. The date is July 1st, 2006, but note that there's a mention here that includes weekend days. Now what that means is that you can have a date returned that is a weekend day or a non-trading day, like a holiday. If that is the case, then what you do is move the actual reversal to the next available trading day. So bear that in mind. So if your reversal occurs on a holiday or on a weekend or some other day that the market's not traded, we'll then move it to the next available day. So how does our date stack up? Well, if we go back to the chart, here we have June 30th, and then we have July 3rd. Now wait a minute, there's no July 1st. So obviously that fell on a weekend. So what do? We move it to the next available trading day, which is July 3rd. And right on time, the reversal occurred to send the market down, and we had a fantastic signal to short the market. Having said that, the fact is that the spreadsheet also has some other factors that can serve our benefit. If we go back to it, you'll note that there is what's referred to as a compare date. Now this is not on the intraday version, but it is on the dated version. Now there are some qualifying factors in talking about that. Basically, a compare date is when the prior occurrence should have happened, giving you a gauge to tell how violently or how strong of a swing the market should reverse off of that reversal. And here's how it works. First off, the date given is typically off one. It's usually later date than the actual compare date. Typically, in this example, 424, you would see it on 423 or earlier, depending on whether it fell on a weekend day. Same thing here. 10/7 would typically, October the 7th would typically fall on October the 6th or earlier, depending if it fell on a weekend. So bear that in mind, that there is a slight adjustment when you deal with the actual date. The second thing is that it depends on the volatility. You see, the greater the volatility, the more severe the reversal. And volatility is simply translated or defined as the swings within the market within a given period of time. The bars themselves, as well as the swings and the width of them and how greatly they swing up or down. If we go back to the April 24th day and go one day earlier back here, we find that we had a fairly good reversal, and it did make a decent little move downward. However, if you look at it, it is not as severe as this reversal and its move. And what's the reason? Well, look at the volatility or the price movement. These bars over here are obviously much more extensive than over here, which are smaller swings in comparison. And so that explains why the reversal is much more severe here and much more profitable over here than it was in this earlier occurrence. Having said that, typically if all things are equal, what you will normally see is that the reversal will result in a swing a little less than its prior occurrence. So we may have a swing that actually comes down just a little less than what it did originally, because the waves tend to dissipate over time. And so that is a factor to consider. But if the volatility is higher, then you can normally expect an even greater reversal than what you originally saw. And that's how you can use the compare date. So these are some of the advantages of using the spreadsheet that you would not have with simply using the graphical method. So there's definitely a reason for taking advantage of this. And we're going to talk about the intraday version a little later. But we're going to focus now on some other factors in relation to how reversal magic works. As we return to our original chart, I've added a secondary triangle here that's in red, with the first high here, the second high here, the low here, and with an intersection point here, giving the time of the reversal right where this low happens. I've done that so we can compare that with our original triangle, which now is all in blue. And to make a point about reversal magic. You see, reversal magic predicts when an expected change in market direction will occur. It does not, however, predict the specific direction the market will take. Now what that means is that even though we may have drawn the points for this triangle that we originally had, we still had no idea whether that reversal will be a low or a high until we actually reach it. The same thing is true with our new triangle. We have no idea whether that will be a low or a high until the market actually gets to it. What makes the difference is what the market is doing just before that reversal occurs. Now, from the standpoint of our original triangle back here, this is pretty easy because we see the market moving up very strongly. And it's pretty easy to know that when we reach this reversal, it will move in the opposite direction or downward and decline as a result of reacting to that. Our secondary reversal, our new one here in red, is a little bit different. We see first off that the market is moving upward. And just before it reaches the reversal, it makes a sharp decline here in red, and finally a second bar down even lower right at the reversal. So even though the market was moving upward, the fact that it moved down just before it reached that reversal told us that the reversal would be a low and not a high. So we could expect that the trend would continue upward following this reversal. And this is an important point about reversal magic. The next point we'd like to make is that not all reversals are created equal. As we learned earlier, volatility impacts the strength of a reversal. Find a more volatile situation and the tendency will be a much more stronger reversal and greater profit opportunity. However, volatility is not the only thing that impacts the strength of a reversal. You see, the market tends to develop dominant trends or swings, and when they're in effect, they produce the stronger reversals in the direction of the trend. A reversal that goes contrary to the trend will tend to be very limited in scope, resulting in very limited profit opportunity. The reversal that sends the market back in the direction of the trend will tend to be much longer and stronger and more profitable. So despite the fact that we are using a reversal method, trading in the direction of the trend still proves the more profitable way to go. Moving to the next point, I want you to take note of this new red triangle that I've drawn. I'm using the high here, and the low here, and that gives us a signal right here at this green bar, which really is of no value to us whatsoever, because it's neither a high nor a low. What happened here? Well, what happened was that I crossed price bars. Anytime you cross price bars with a diagonal line in between the first point and last point, whether that be two highs or two lows, then it implies wave interference, and the signal will be poor and of no value. The exception to that is if the crossing is very slight, maybe perhaps one bar, and very close to the first point that you're using. In this case, we crossed the bar with our blue triangle that we originally drew, and typically it will result in perhaps a bar off of the actual signal or timing. In our case, it didn't impact it at all, but this little bit or another bar like it could have easily have altered the timing by one bar. Now, if that little bit can alter the timing, imagine what this does when you're dealing with several bars that move quite dramatically through the line. So therefore, you want to avoid crossing the path of price bars at any point. Now, after the last point, it doesn't matter that you cross the price bars anywhere here afterward. But anywhere in between, from the first point to the last point, you want to avoid crossing price bars. Data integrity and data presentation is critical for the accuracy of reversal magic. And so let's take a couple of minutes and talk about that. This is the S&P E-mini, and the S&P E-mini on the U.S. markets has a participation of special trading where most of the activity takes place during the day. As you can see here, you can see how strong these bars are, how well filled in they are, and you can see the volume down here where the participation is rather high. It also has Globex trading, which is overnight trading, and you'll see that oftentimes that activity is rather spotty. Very little activity, the bar is very small, and oftentimes just one brief dot. You can see the volume down here is almost non-existent. It is almost like two completely different markets that are combined in an overnight chart. Now, most chart providers do have the ability to exclude overnight data. An example of that, if I go to a regular chart, you can see the difference. Here, the overnight data has been removed, and it is a substantial difference. If we go back to the market activity with overnight data, what you find is that if you try to incorporate this low participated time, the strength of the reversals will typically be rather weak. For example, if I take these 2 points and generate a series of lows and a high here, you're going to end up with a reversal that is nothing more during the day but a pause. Very little strength before moving on downward. Now, not to say that this isn't a value, but the fact is a low strength reversal can impact how you're able to trade it and how successfully you are. You want to see some movement off of your reversals. So the data needs to be appropriate for your actual trading. So wherever possible, if you're trading during the day or during a highly participated market, stick with the highly participated activity and avoid the low participation if that specific market has the ability to be traded off times as well. The next factor in regard to data is something that really is of common sense. If you have a data provider that has frequent errors in regard to the data they provide, chart has a lot of gaps, openings, or errors in general, then obviously that's going to impact your ability to determine accurate reversals. If you don't have the right high, you've got a problem. If you don't have the right low, you've got a problem. If you have missing data, you've got a problem. So it's important that you have a data provider that's reliable and can provide you with the accurate information on time. Doing so will improve the quality of your reversals. One final issue we want to cover in regard to data presentation has to do with what's commonly referred to as price scale. Now, there are two forms of price scale: semi-logarithmic, which is semi-log for short, or linear. And depending on which you use can in fact impact the accuracy of reversals. Now, many charts have the choice of either one, and you can see, for example, here I have a choice that I can click for semi-log for my price pane. And if you look at the price bars as I click it, you'll see that the price movement or the price bars change their position. Now, why did they do that? Because on semi-log it works off of the percentage of change. Now, if you're using a market that's in a consolidation or a trading range, then you're not likely to see a great deal of movement, or it's not in turn likely to affect or impact your reversal accuracy that greatly. But if you're dealing with trends that continue on, or you're setting new price levels, and it's rising up, then you will start to see a substantial difference. You see, if you have a price level 100 and compare that to 0, and you happen to move to 200, the difference between the 100 and 200 will actually be greater on a semi-log chart than from the 100 to 0. The reason is because it's working off percentage. The greater the increase, the greater the percentage, and so it will distort the chart. And this is a typical type of chart used, for example, in a long-term Dow. So typically on long-term charts you will find this more of an issue than on short-term charts. However, it does make a difference, and so what we recommend is that you avoid using this scale entirely. Instead, go to linear, which maintains the perspective and the levels that they move to. If you happen to, by mistake or because you don't have the choice, happen to use a semi-log, as long as it's not a market that's continuing to move to higher levels, to many cases you'll be able to get away with it without too much difficulty. But whenever possible, where it is an option that you have available, use a linear choice, because that's going to be the more accurate in regard to setting and determining reversals. This completes Reversal Magic training video number 1, how to determine future reversals. This is a production of the Parsons Trainings. All rights are reserved.